everyone. Welcome to our training call tonight. I am so excited to bring Michael Pierce, who is my tax guy that saves me tons of money and gets me refunds every single year. We often have a conversation that everyone should own a home-based business, if for nothing else but the tax savings alone. So I am going to not take up a bunch of time. I'm just going to just know that I've been working with Michael, he's been taking care of my taxes with Craft Financial Solutions and saving me a ton of money for about 10 years now. Can you believe we've known each other long, Michael? And I'm going to turn it over to you so that you can share all of this great information with folks. And if they could, if we could hear them, they would be clapping right now saying, yay, because a lot of people are very interested in this. So take it away, Michael.
All right. Wow, 10 years. That definitely makes me feel old, and I'm a young guy. Okay. Well, thank you, Bernadette, for having me on the call tonight. Before we dive into the material and what I want to share with everyone, I'd just like to take a few minutes and just give a few words about myself and my firm. Some of you on here know me, but I'm sure there are several of you on here on the webinar that do not know me. I have been a practicing accountant on and off for about the last 13 years. I have worked with clients in all 50 states, and I pretty much have worked in all industries that we have in this nation. Providing tax advice, tax planning, working closely with the Internal Revenue Service and state's revenue department, and of course, preparing tax returns. This past January, I became a tax partner with the firm Craft Financial Solutions. Our firm is located in southern Indiana, right outside of Evansville, Indiana. As you can tell from my accent, I am originally from the beautiful, beautiful Commonwealth of Kentucky. If you have never visited Kentucky before, shame on you. I highly recommend everyone to at least get down there and visit it once. Of course, when I'm down there, I reciprocate. I tell everyone down there that I pretty much give the same compliment to the state of New Hampshire. New Hampshire is also a very beautiful state. With our firm being down in southern Indiana, I do work remotely here in New Hampshire, and I service all of our northeastern clientele. Our firm, of course, has been servicing clients for many, many years, with an emphasis in taxation is our main emphasis. We do general accounting, and we also do financial planning. So I just wanted to take a few minutes and just kind of give a little bit of background there. All right, so let's get started here. I'm pretty sure when you guys saw the post that Bernadette had sent out about the topic of tonight's call, you were probably like, hang on a second, it's August the 29th. Why, Labor Day weekend coming up, why in the world are we doing a call about taxes? It's nowhere near time to do taxes. And my simple answer to this question is tax return filing. That's a seasonal thing. You do that at the first 3.5, 4 months of the year. But thinking about taxes and getting ready and preparing yourself and your business for taxes, that is a year-long and a year-round thing. That never stops. That shouldn't stop. You should always be constantly thinking about your taxes, how your taxes are going to affect you, and you should get into a routine and get into a habit of thinking about your taxes, your financial situation, how it's going to be at the end of the year. You should be thinking about that, if not each week, at least each month. And believe me when I say the more you think about taxes and the actions that you do take throughout the year, the more benefit you will see come February, March, and April, whenever you file your tax return. And another advantage that I advise my clients is that, if you do this, if you think about it year-round and are constantly thinking about it, it makes that quote-unquote tax time not seem very scary, surprising, things coming out of the left field, and of course, frustrating. I know, I've like I said, I've been doing this for about 13 years, and the average person finds it very, very frustrating, tedious. They just don't want to involve themselves with it. But it's very, very important. It's just as important as the making money part. To make sure that your taxes are in your forethought, and that you're doing what you need to do all the time, so that you can get the best benefit of what's out there for you. So the topic that we are going to talk about, and kind of the question that was posed for this webinar, is why should everyone in this country actively work a home-based business? And the answer to that is because, believe it or not, our government and the IRS want you to have one. Our country is actually set up into two separate tax systems. You have an employee tax system and a business owner tax system. If you are an employee, you are extremely limited. You have a cap on what you can deduct to go against your income. Majority of employees will only be allowed to deduct an item that is part of the itemized deductions list that is on Form Schedule A on their 1040s. If you add up all those categories, that's roughly around 12 to 15 different categories of deductions that you can take. The flip side of that, a traditional business owner has about 50 to 60 different deductions that he or she can take advantage of. Going a little step further, you see there, right, being a business owner is a lot better than being an employee, but going even further, a home-based business owner, you have around 130 different tax deductions that you can take advantage of. Pretty much double what you can take being a traditional business owner. The IRS will allow a business, doesn't matter if it's home or traditional, that is engaged in earning or working towards earning profit. They are entitled to these deductions in pursuit of that income and profit. Our government, although some people think, our government didn't make a mistake allowing home-based businesses to be able to have that many deductions to decrease tax revenues they collect on. They allow home-based businesses on purpose for good reasons. Home-based businesses keep our economy strong. This is why you are allowed to deduct all these expenses that help, quote-unquote, carry your business in its startup years. The government hopes, the trade-off on this is the government hopes that your tiny, small, startup home-based business will one day thrive and grow and become a huge, big business one day. Another reason home-based businesses are allowed is that they are a part of the small business area, the small business sector of our economy, which makes up about 75% of the economy's revenue. So basically, having a home-based business is set up to, the way I always advise it is, if you have a home-based business, it's set up to help your personal economy, and hey, you feel like you're chipping in to help our national economy. One thing before we dig in and start talking about the different tax breaks and the different deductions that you can take for having a home-based business. And by the way, I'm not going to go over all 130 of them. If I did that, we would probably be here until midnight. But before I start kind of getting into the specific areas, I do have some due diligence I have to do, and I do have to advise everyone that is on the call that no one should start a home-based business for the purpose of just getting new tax deductions. That's not the intent of the 130 deductions. That's not the intent of the tax law surrounding home-based businesses. And that's not the reason that the government allows you to have a home-based business. The deductions are the result of having a home-based business, not the reason for it. So I just wanted to make sure before I began, everyone kind of understood that. If you have any further questions about that, I can definitely assist you with that.
So Michael, just as a quick add, really
Sure.
is when someone is starting a home-based business, they truly have to be in pursuit of profit and building the business, correct?
Yes, I will get more into that towards the end. There is a thing called the intent for profit test that the IRS does kind of put a home-based business through. But yes, that's correct, and I'll kind of touch more on that here in a few minutes. So, okay, so let's kind of look at what can you actually deduct. Okay. To me, one of the greatest things about having a home-based business is that some of your current day-to-day expenses that before having a home-based business you dished out money for, but you didn't get anything for it. You couldn't get a deduction for it. With having a home-based business, that changes, and that's in my opinion, that's an amazing thing to have. So let's just go through some of the. I will touch on some of these in more detail, but I just kind of wanted to, just so everybody just had a just a general understanding of what you can take a deduction for with having a home-based business. Of course, mortgage interest and real estate taxes, we all know that that is something that you can already take as a employee or business owner or any of these categories. That is something that 1040 that goes under Schedule A. So another area that you can take as a home-based business, but you can't if you're just an employee, is your rent. So if you don't own your home, and if you don't have mortgage interest, or if you don't have property taxes, but you have rent, with having a home-based business, you are allowed to take a portion of your rent as a deduction. Your utilities, gas, electric, water, sewer, all of your, something to point out here, all of your necessary expenses, you're able to take a portion of as a deduction. When I say necessary expenses, if you have an expense like, you pay for cable, cable is not considered, even though it's something that we kind of consider a, utility because, we pay it every month for our homes. That's not a necessary expense. IRS does not allow you to take cable as a deduction, so for home-based business purposes. So let's say that you have a maid service, a cleaning service that cleans your house. Obviously, if they clean your house, they're going to clean your whatever area that you have for your home office with your home-based business. So a portion of that is deductible. If you were to buy a new computer, a copier, a fax, a phone, any type of electronic that that you need for your business, office supplies, your paper, your ink cartridges, your pens, your postage, that's all deductible. What if you need to purchase items for your home office that you need to work like a furniture, like a desk, let's say a sofa, a conference table, any other type of furniture. If you were to, let's say you didn't buy something and you wanted to lease some type of equipment, rent or lease some type of equipment for your business, that's deductible. Any repairs and maintenance to your home, a portion of that is deductible. A portion of your cell phone and internet bill. That's something that we all have. We all have cell phone bills these days. We all have internet bills these days. If you were to have a home telephone line, now this one's a little tricky. The IRS will not allow you to, if you have just your initial home phone line, the IRS will not allow you to take a deduction for that. But if you have a second home line that is designated for your business, for your home office, the IRS will allow you to take a deduction for that. Travel expenses, hotels, car rentals, things of that nature. Let's say contract labor. If the IRS for home-based business will give you a deduction for, if you're paying people or vendors for different services that's over a certain amount. Materials, supplies, products that you purchase that are considered, an area that's a cost of a good that's later going to be sold. Of course, minus your personal use. If you have items that you purchase that are for personal use, you can't take a deduction for that. Books, magazines, publications, that you buy for your business. Going out to eat, entertainment. Now this one, let's talk a few minutes about this one. Meals and entertainment deduction. This is a deduction that you do not get 100% deduction, but you do get 50%. So let's say you have a business prospect, you guys go out to eat at the 99s, and you pick up the 99 restaurant, you pick up the tab, the bill was $100, you get a $50 deduction for that meal. When it comes to meals and entertainment, a little bit of homework on this one. Easiest thing to do is to keep the, pay with a credit card or debit card, and keep the slip, your copy of, the customer copy of the slip. And for a meals and entertainment, for meals expense to be legitimate through the IRS, it has to be documented at the time that the meal occurred, and there are 4 items that have to be on this receipt. That would be the date, the amount of the bill, the place, restaurant, wherever, the purpose, and the relationship of the person or people that were there eating the meal. So that's something to kind of get in the habit of doing if you are going out and going out for meals and entertaining people that way at dinner. Easiest way to do that is don't take the customer copy receipts, put it in your wallet, or put it somewhere else when you get home. Take a pen out right then and there, and make sure that you write those 4 things that I just mentioned on that customer copy receipt right there, the same time that you're putting the tip on, before you close up the, the thing that they give you with the pieces of paper in it, hand back to the server. Do it right then and there. You do it right then and there, you're least likely to not forget about it. If you have a security system, your monthly fee for a security system is deductible. Your home-based business, always a good idea to have a separate bank account for it. That bank account will probably have, more than likely, will probably have some fees that, some monthly fees, annual fees, whatever that goes along with it. Those are deductible. If you were to get a credit card that was 100% for business use, whatever the interest that you pay on that credit card, that's deductible. Legal and professional fees. Whatever you pay a year, to someone like me, to your accountant, or to, if you needed something regarding your home-based business that you needed, an attorney for. Any type of, professional fee is deductible. Advertising, this is huge. You have a brand new home-based business, or you have a home-based business, you have to promote it. You have to market it. You have to advertise it. You're going to get business cards. To pass out. All that is deductible. Health insurance premiums. Of course, we all know that health insurance premiums is also something like with the mortgage interest and the property taxes. That is something that that also an employee can take a deduction for. One thing I just wanted to mention about the health insurance premiums that coincide with a home-based business is that if you have a home-based business and you're paying for your health insurance, out of pocket, you're not a part of some employer plan or anything like that, you can deduct 100% of the premium to the extent of your home-based business's net income, net profit. If you have a situation where you don't have a net profit, that you have a loss, then you still get the benefit for that, but it just goes on just the normal Schedule A, just like any other insurance premium. If you had an insurance premium that, if you didn't have a home-based business. This is a pretty good tool because, pretty good strategy because, if you do have a net profit, then it's a way for you to get a full benefit of the health insurance premium, and it bypasses the 7.5% threshold that you have on the Schedule A itemized deduction form on your 1040. So I just wanted to mention that. All right, so that's kind of just an overall list. Now what I'm going to do is I have a few that I'm just kind of going to go more in depth on, kind of give you more specifics. And then I have a couple of kind of scenarios and kind of tax deductions for having a home-based business that you probably didn't know about. You probably didn't know you could even do that. So I want to give you a few of those as well to kind of get you thinking in a different way. So when I was going through the list, Bernadette, am I pretty good? Can people are hearing me and everything's good, right?
Yeah, absolutely. Everything's good.
Okay.
You just want to say, ask one thing and make sure. Sometimes with home-based businesses, we buy samples and different things like that we hand out to people. That type of stuff would be considered advertising.
That's a very good question. If it is samples, and if you are not taking them, if you can classify it as for business purpose only, you are not also taking those samples, you did not buy those samples for your personal use, then yes.
Okay, terrific. So like the Bula bottles, that the 10-play packs that have the samples that people are giving out, that would be considered tax deductible.
Yes.
Awesome.
If you bought those for the purpose, when you initially bought those for the purpose of using those to promote your business and to give out, and not to keep those and use them personally and then give, somebody comes over your house, like, hey, I bought these Bula bottles, here's a Bula bottle. That's not deductible because that wasn't your intent. But if your intent was to use those Bula bottles for the purpose of promoting your business, then yes. That answer the question?
Yes, it does. Thank you so much, Terrific.
Okay. Yep. No problem. All right, so one of the areas I wanted to kind of go more in depth with is the business use of your home deduction. As I was going through the list there, if I'd mentioned some areas that are home expenses that take a portion of. This is a really nice deduction. Kind of gives you, as I mentioned at the very beginning, it kind of gives you an area to take a deduction for on money that you're already spending that if you didn't have a home-based business, you wouldn't be able to. You would just be dishing that money out and not feeling like you're not getting some type of a recapture from it. For this business use of home deduction, to qualify and to be able to take a portion of your home deductions, you need to pass one of the 3 tests. Your home office must be where, and this is, I'm actually directly reading this, your home office must be where the primary value of your business is delivered or where you regularly meet with customers or prospects or where the primary management or administrative function of your business is conducted. I know that was a mouthful. So those are the 3 tests. That was all the 3 tests. So if you're looking, if you were kind of paying attention to those 3 tests, pretty much everyone qualifies for the third one, for number 3. And number 3 was where you take care of your primary management or administrative function of your business. Okay, so pretty much everybody, 99% of everybody qualifies with number 3. So now that you know that you qualify to take this business use of home deduction, now you need to calculate the percentage of your home that is used for this deduction, for this home office area that that you can get a deduction for. To do this, you just need to divide the total square footage of your home by the total square footage of your home office area. So just to give you a quick simple math example, let's say your home is, let's say it's 2,000 square feet, and you use a bedroom as your office. And let's say the bedroom is 10 by 10, 100 square feet. Then your business use of home percentage for the deduction is 5%. So you wouldn't be able to take more than 5% of certain expenses that you're paying for your home because that's the only portion of your home that you're using for business. So there's really no way, in 13 years I've never seen a way, and I wouldn't even recommend doing this, I've never seen a way where you can make your whole entire home a 100% so that your whole entire home can get a, basically everything that you're paying for your home is 100% deductible. It doesn't work that way. So certain home expenses.
Just for
yeah, sure.
Does it have to be a room, or like when I first got started in a home-based business, I didn't have a whole room, but I did have like an area in my house that was part of the living room.
Yeah, that's fine. Basically, the rule is that I typically just say, bedroom, because a lot of people in homes have, just have an extra bedroom that they kind of have set up as a home office. But, let's say that you have, I'll give you an example to better clarify this. Let's say that you have your 10 by 10 room, which is your home office. Okay, that area is automatic, would count for the business use of home deduction. But let's say that you have a conference table, or let's say a kitchen table, in your den or whatever, the section of your den, and let's say that you don't really take people into your office when they come over to your house to meet, for your home-based business, to meet prospects. Let's say you meet at the kitchen table. Well, that square footage would also count as being part of your, as part of that total home square footage that would be divided up from your total square footage. So in that example, you would be able to have the 10 by 10 room, and plus you would be able to have whatever the square footage of that table would be. So that would be an example for you. Or I had someone ask me one time if they had a bookshelf that wasn't in their home office bedroom, but it was in the living room, but the bookshelf had nothing but all of their, publications, magazines, all of their, folders of all their prospects, pretty much the whole entire bookshelf was nothing but for their home-based business. And I wasn't 100% sure about that, so I actually called the IRS, and the IRS that that if it doesn't have anything else on that bookshelf but 100% nothing but business items, then whatever the measurement of that bookshelf would go into the calculation as well. So those are just some examples of things outside of your kind of main home office area that you can pick up to go into that calculation as well.
Awesome, thank you.
Yep, no problem. So so let's just kind of recap what the deductions would be for this business use of home. So it would be your mortgage or rent, mortgage interest or rent, your property taxes, your utilities, repairs and maintenance to your home, homeowner's insurance goes into this calculation, goes into this deduction, your security system that you pay monthly for. Let's say you have HOA fees that you pay, that goes into this deduction. Snow removal, whatever you pay for snow removal, that goes into this deduction. Depreciation of your home, you're also allowed to, even though it's your primary residence, you're also allowed to take a depreciation expense of your home pro rata to your business use percentage as a deduction as well. Let's see. One thing to note about this deduction, just want to make this clear, is that mortgage interest and property taxes, you get this business use of home deduction regardless. If you have a profit, if you show a net income or if you show a net loss at the end of the year, the other expenses that I just mentioned, if you have a profit, then these expenses, that whatever that number comes out to be after the percentage goes against your profit. If you don't have a profit, so let's say you have a loss, then you don't lose that deduction. You just can't use it for that specific year. That deduction carries over until next year. If it'll get used up if you have a profit next year. Whatever the first year you have a profit again, it will get used at that point. So you don't, even though you may not see it in the current year, it does carry over. It does carry over, and it gets used up whenever you do have a profit. So just want to make sure that was explained. Okay. All right. So here we are. So we just talked about the first one. Okay. So all right. So let's talk about depreciation. As I mentioned, when I was going through that list, you know, if you were to buy a computer, if you were to buy a desk, if you were to buy a fax machine, you know, a sofa, anything electronics or furniture that you know, that you need for your office, you can take a depreciation deduction for these items. And you can take this depreciation deduction in two ways. After you started your home-based business, any new furniture, new electronics, new items that you have purchased after you started your home-based business, you can take a depreciation expense for those items. But let's say that the other way, let's say that you have, let's talk about the same bedroom, the 10 by 10 room. Let's say that, you know, there was already, before you started your home-based business, there was already a sofa in there. There was already a desk in there. There was already a computer in there. You didn't need to buy anything. You didn't need to buy anything new. You can actually convert those items from personal use over to business use and be able to start taking a depreciation expense on those items. If you purchase new items, you can depreciate the cost that you pay for the new item over 5 years or 7 years. That depends on what the item is. Computers, electronics, the depreciable life of those items is 5 years. Desks, sofas, lamps, you know, tables, anything like that, the depreciable life of those items is 7 years. And, you know, keep in mind, you're only able to depreciate the percent of business use for these items. And you'll get a depreciation deduction each year until the cost, whatever you paid for it, is used up. So, you know, if you, let's say you bought a computer for, let's use the sofa as an example. Let's say you bought a sofa for, you know, $1,500. So $1,500 is your cost. So over the next 7 years of that $1,500, you're going to get a portion of that $1,500 as a depreciation expense over the next 7 years. So let's go back and talk about converting a personal item to a business use item. So it's not something that you just bought, so you really can't use the cost as kind of the, you know, the basis for the depreciation amount. What you do in that case is you actually you kind of take the value. You take the value of what the item is at the time of the conversion. So right when you start your home-based business, whatever you feel is the value of that sofa, that would be the same as if you were to go out and if you were to have a cost for that sofa. I typically advise clients when they're thinking about values in that case. Unfortunately, the easiest way to do that, you don't really get a whole lot, but I guess something is better than nothing. But you know, just kind of think of it as the value as if you were to, you know, kind of like a thrift store value. You know, if you were to take it to Goodwill or if you were to sell it in the yard sale, that's the easiest and kind of the safest way to value something. If you didn't, you know, if you didn't purchase it that year, if it wasn't a new item. So let's say that something else under depreciation I want to mention. Let's say that you bought a brand new computer, and let's say you bought that computer for your business, nothing but for the business. You know, you're not going to let anyone else use it. You know, you're not going to use it for anything personally. It's just when you turn it on and you turn it off, it's just strictly for business. The IRS will allow you to take 100% of the cost of an item that you use 100% for business that you purchase. This is actually, there's a name for this. This is actually called Section 179 deduction. So that is a way that's actually a way that you can get more for a deduction for a specific particular year. If you know that something that you're going to buy is going to be 100% for business. If it's not going to be 100% for business, if it's going to be 50% for business or 75% for business, you cannot take 100% of the cost in 1 year. You have to depreciate it over the life of the asset, as we've been talking about. You know, Section 179 deductions. It's a really good tax planning tool to use. You know, you may buy something. You know, before the end of the year, you may buy something, buy a brand new computer, and as long as you buy it for the end of the year, you know, if you're going to use it for 100% for business, that's something that could benefit you for that current tax year. So definitely a really good way to get something 100% that you buy for your business. One other thing about the Section 179 expense is that kind of like the same thing as we were talking about the business use of home expense. It only kicks in if you have a net income, if you have a net profit. You never lose it. You don't lose the Section 179 deduction. It will also carry over until the first year you do have a net profit, and then you can use it then. So going back to when I was talking about tax planning strategies, you know, if you're getting close to the end of the year, and you know you want to, you know, if you have a net income, you know, if you want to try to lower that as much as possible, I may advise you, you know, if you can, you know, to go out and, you know, buy something new that's 100% for business, so that you would be able to get 100% right off of the cost that you paid for it, you know, to help you in that particular year. So that's wanted to make sure you guys kind of understood that. How am I doing on time, Bernadette? Am I good? Or am I?
Yeah, you're good. We'll be at an hour and about 15 minutes, and we want to give people the opportunity to ask questions. So.
Okay. All right.
15 more minutes.
I will. I'll speed up a little bit here. Okay. All right. Let's talk about. We're going to switch gears here. Let's talk about one of the biggest tax deductions that you can take with having a home-based business, and that is vehicle expenses. See here on my PowerPoint here, you know, I put you know, keys and ignition. You know, the key to the largest, you know, your largest single tax deduction may be your ignition to your car. With vehicle expenses, there are two types, two methods that you can do. One is called actual expenses, and one is called the standard mileage deduction. Throughout the year, you do have to keep up with both methods, but you choose which method is more beneficial for you based on how much you spent with actual expenses and how many business miles you drive in a year. So let's first talk about the standard mileage method. You'll probably use the same vehicle for both personal and business use. Majority of people that have a home-based business do that. So the IRS does have a requirement. They want you to maintain a vehicle use log, mileage log is another way to put it, each year in order to determine what percent of your driving is considered business. The log, the mileage log, must contain 4 items for it to be a legitimate IRS standard mileage deduction. The 4 items should have the date, the destination, the business purpose, and of course the number of miles. The destination and business purpose, that can be a little vague. It doesn't need to be 100% precise, but you do have to have that. And of course, the last filing season, business miles, the IRS allows you to take 57.5 cents per business mile. So, pretty much, every 2 miles that you drove was definitely over $1 that you got as a deduction. So that's pretty much the business mileage, the standard mileage method. So actual expenses, of course, would be what you pay for gas, oil changes, repairs to your vehicle, your car insurance. You're also allowed to take a depreciation expense for your vehicle. Same concept as the other depreciable assets that we were talking about. Basically you take your cost or you take your value, and vehicles are spread out over 5 years. So you would take a tax deduction for each one of those years. So a question that I get all the time regarding actual expenses versus standard mileage is what about mileage from my home to work, and then I speak to someone at work about my home-based business, about my product, about my service. What does the IRS allow that to be a legitimate business mile? And the answer to that is the IRS does not allow you to deduct miles from your home to your place of employment. That's a huge no-no. But the IRS does allow you to deduct mileage from your place of business, which if you have a home-based business, is your home to another place of business. That would be a business prospect house. Going out to get supplies for your business, anything like that. So going from your home, and the IRS uses the term tax home, to another place of business, from business to business, that is considered a legitimate deductible business mile. So in that example, you would be able to deduct the miles from business location to business location. But another thing is that the IRS they always give you the benefit of a round trip, of a return trip. So if you leave your tax home and go to a business prospect's house, or conducting business some other way, then you automatically get the mileage there, and you automatically get the mileage back to your home. So I deal with that a lot. People will give me mileage just from going one way, and I have to advise them and tell them all the time that that you also, the IRS also gives you the return trip as well.
Because of the amount of miles I drive, that's my favorite deduction.
Yeah, yeah. I can point out that I've said that it's the largest, and that is very true. A lot of people with a home-based business, their largest deduction out of all the deductions that you have the advantage, you have the ability to take, business mileage or actual expenses is the largest. Yeah, no doubt, no doubt. So when you get to the end of the year, you have your business miles, you have your actual expenses, you have everything totaled up, okay? And so now you get to choose which method do I want to take. So you can choose any method, any of the two methods, but whatever method you choose, you must use that same method for 5 years or until you were to get another vehicle. So if you choose the standard mileage method, then you can do the standard mileage, but then the third year do actual expenses. Vice versa. If you do actual expenses, then the next year you can do standard mileage. Unless if from that year 1 to year 2 you were to get another vehicle or to place another vehicle in service. So that's pretty important to point out. Regarding vehicles, another depreciation that you can take, and a lot of people will do this. You'll see commercials at the end of the year, right before New Year's Eve, New Year's Day. You'll see these commercials from car places that will say, buy before December 31st. Get a tax deduction to buy a vehicle before December 31st. Well, one of the reasons for that is because the IRS, if you have a home-based business, the IRS will allow you to take a special depreciation expense if you were to have a vehicle that you were to put into service that is 6,000 pounds or more. So if you were to buy a vehicle that's 6,000 pounds or more, whatever you paid for the cost of that vehicle, the IRS will allow you in that same year that you bought the vehicle, they will allow you to take a $25,000 up to $25,000 deduction of the cost of that vehicle for that year. Now the rest of it, if it's over $25,000, the rest of it has to be spread out. But for that initial year, you can take a $25,000 deduction off of whatever the price was that you paid for that vehicle. There's a lot of vehicles out there that are 6,000 pounds or more. When you say it like that, it sounds like it's a lot, but pretty much a lot of your trucks are, a lot of your, if you were to get like a Ford F-250 or Dodge Hemi or anything like that, those are all kind of over the 6,000 pound threshold. A lot of vehicles out there that are over 6,000 pounds. If you're thinking about that, you can just go to Google or any other place, or even ask the dealership. You can just go to Google and just put in, how much does whatever vehicle you're looking at weigh, and it'll tell you how much it weighs. So you can kind of gauge and not go buy a vehicle thinking if you're gonna wanting to get this deduction, go buy the vehicle and come to find out it's 5,500 pounds or something like that. So I've actually had that. I've had that situation happen before. So someone bought a vehicle thinking that they were going to be able to get that nice $25,000, and come to find out it was like 5,600 pounds. So okay. One thing about a mileage log, real quick before I move on, one thing about a mileage log is that you can recreate a mileage log. It's kind of one of the areas that the IRS will allow you to recreate. So let's say that you were to be examined, not to say that's, people, we all know people do get chosen, people do get examined, not to bring any of that up, but if you needed to present a mileage log, you do have the ability to go back and recreate it. But the easiest thing to do with your mileage log is I advise people to keep in your vehicle, just keep one of those Mead composition books or something like that, where you can just kind of stick it right in the side of your car door, or put it in the middle, and leave a pin there. And when you get in your vehicle, start writing. When you get to wherever you're going, before you get out of the car, write it down. That way, you're constantly keeping up with it, and you're not getting to tax time and you're like, well, I think I had 15,000 business miles, but I'm not really sure. So it's just a lot easier to keep up with it as you go, and it's a lot easier than trying. You can go back and recreate it, but if the IRS is going to allow you to take the deduction, you don't want to shortchange yourself. So a lot of times, if you don't get in a good habit of doing it as you go, you may shortchange yourself. So, okay. All right. So, real quick, I wanted to go over two types of deductions that majority of people, some people may know about them, majority of people may not know about them. I just wanted to kind of highlight and hit these two real quick, kind of get people thinking in a different way, a different direction here. First one is if you have a home-based business, you can hire your family members to help you with your home-based business. Having a home business allows you to hire your kids, for the most part, to do the filing. You can get them making copies, cleaning the office, whatever you want them to do. The thing about this, there are some steps and procedures that you have to abide by, but believe me, the deduction can definitely outweigh all the kind of the tedious steps and procedures that you have to do. Basically, majority of us will give our kids an allowance. So instead of giving them an allowance, just kind of change that over to giving them a wage for helping out. If you're classified as a wage, the wages are tax deductible to your home-based business. And if you were to keep what you pay them, if you were to keep it below a threshold amount, then the income that would go to the kid, to the child, would be 100% tax-free. Just to kind of tell you what the threshold is, it's below or equal to each year's standard deduction amount. So whatever, the standard deduction amount increases a little bit each year. So whatever it is for that year is the kind of the threshold that you can pay your child under that or equal to. And, if you go above that threshold, then, that kind of kicks in where they may have to, pay the 10% tax rate themselves, file their own tax return. So if you were to keep it below that standard deduction, then that kind of bypasses all that. Just something else I wanted to note about this procedure. The earnings of a minor, even though it would be free and clear from the federal, it still could possibly, wherever you live, whatever state you live in, could possibly be subject to state payroll taxes and having to file a state payroll tax return. The home-based business having to do this on those wages. Just depends on which state you live in. Federal, you're good. Some states, they require the home-based business to, to pay some payroll taxes to the state on that. But that's something we can talk further about, if anyone is interested in that. So there is some paperwork you have to do for this. You do have to have on record, you do have to have a signed employment agreement between the home-based business and the child. That has to be on file at all times. You have to keep up with a timesheet each week or biweekly. You have to write on the timesheet the actions that were performed by the child. The wages must be reasonable. You got to pay consistently, and of course, you do have to file a W-2 at the end of the year. But just because you file a W-2 at the end of the year, like I said, as long as it's below that standard deduction threshold, then it's free and clear. Another note with this setup. Get this question from time to time: how old does my child have to be? Can they be 9 years old? Can they be 12 years old? Do they have to be a certain age? So the IRS will allow for this. The IRS will allow children as young as 7 years of age can earn wages and be an employee with their parents' home-based business. And one other kind of nifty thing about this whole procedure is, if you're paying your child a wage that's 9 years old, if they are going to either put it in their own bank account or you would put it in your bank account, even if they have their own bank account, since they're underage, since they're a minor, you would be on the signature card. You would be the custodian. So in essence, you would still have control over the amount of money that you would pay them. So you could turn around and use the money that you paid, the wages, and you can use it for the children's benefits. You could use it for things that they need. You could use it for clothes, back to school clothes, music lessons, new shoes, whatever. So that's something that's very, very neat about being able to hire your kids to help you with your home-based business. A lot of people don't know that you can do that with a home-based business, but yes, it's definitely out there, and you can definitely take advantage of it. So another area that people ask me a lot about has to do with vacations versus business trips. One thing to kind of keep in mind is that, if you are in New Hampshire and your home-based business is in New Hampshire, then, it's not territorial. It doesn't necessarily need to just be in New Hampshire. You can have clients, you can have prospects, you can have customers, you can send your product and sell your product anywhere, all over the nation. And, this means that wherever you travel, of course, you can be traveling on business as well. Travel expenses for business, as I just mentioned, can be greatly tied into family vacations. Huge deduction for this. A lot of people are kind of iffy about it. You know, they want to take a deduction for it, but you know, they feel that, you know, it would be something that that would cause a red flag, I guess you would say. But there are some steps that you do need to follow to make it a legitimate business trip and not considered a vacation. And there's also, what I'm going to talk about, you can make a vacation also a business trip. You can kind of, these steps I'm going to tell you kind of makes them both legitimate. So let's kind of look at what the IRS thinks about this. One, they make it very specific and they make it very clear on what needs to be followed. They say that anytime your work requires you to sleep and rest away from your place of business, which for a home-based business is your home, that you must meet a 5149 transportation rule. That's the actual name of the rule that they have written into their internal revenue code. If you were to combine business travel and personal travel, you are allowed to deduct 100% of the travel cost if more than half of your days qualify as business days and less than half of your days are considered non-business. So the first question is, well, what's actually considered a business day? I know what a non-business day is. What actually is considered a business day? So the way that the IRS specifically kind of demonstrates this is that right off the bat, your travel days to and from your destination, the IRS automatically gives those to you as business days. So you're at the airport all day long, or you're at the airport for half a day flying, doesn't matter. The IRS gives you that whole entire day to and from as a business day. Another definition of a business day that the IRS lays out is if you conduct business for at least 4 hours a day. So your 2 travel days, we already know, those are considered business days. So any other day in between your two and from days, as long as you conduct business for 4 hours, at least 4 hours in any of those days, that is also considered a business day. And then, you know, the next question is, well, what about if I arrive and I leave and there's a weekend, you know, there's a weekend in between, or there's a holiday, that Monday is a holiday, and, you know, if all that's in between, how does the IRS deal with that? What do they, you know, what's the rule for that? Well, for weekends and holidays, the IRS does allow weekends and holidays to be considered business days as long as they fall in the middle of 2 business days. So a business day on one end and a business day on the other end. So if you were to take that example, and let's say that you fly somewhere on a Wednesday, your Wednesday is a business day because that's your travel 2 day. Let's say you do business half a day Thursday, half a day Friday. You don't do anything for Saturday and Sunday. Those are your play days. You do business half a day on Monday, and you fly back on Tuesday. That right there is a example and a setup to where you would be able to take 100% of all your travel costs for that trip. So that's a way, an example of how you can also factor in some, some off time during the other times that you're, you're there for business. So that's kind of a really good example. Is start on a Wednesday and come back on a Tuesday. Another question I get regarding vacations is, what about a cruise ship? We're going on a 10-day cruise, and while I'm on the boat, I've got 2,500 people that's stuck on the boat with me, and I'm gonna prospect every single one of them. IRS is pretty strict about cruise ships. They say that there's no wiggle room with this. If you are on a cruise ship, none of that can be deductible. None of it whatsoever could be deductible. I have read where this is actually a tax court case. I have read where someone they didn't do their business on a cruise ship, but they did their business on a when the cruise ship had ported, when it was at a port. And I can't remember specifically, but there were some other kind of things that they did once they got to the port off the ship that that made it basically they won in front of the IRS, and the IRS allowed them to make make that part deductible. So cruise ship, no. If you were to organize something on a port that's where you're not on the cruise ship, possibility. So, like I said, the IRS is pretty strict about cruise ships. Okay. All right. How am I doing on? I know I've went. I think I went way over, huh?
Yeah, a little bit, but that's all right.
Okay.
I just want to. I know that people are going to have a lot of questions about some of the stuff that's on the screen. IRAs, home-based businesses. You have a plan. All of that kind of stuff. Everybody take down Michael's information, and if you have specific questions about specific things, make sure that you get in touch with them. I know that Joe Kraft's office or the Kraft Financial Solutions, one of the things that they do for folks is they will do look at your last 3 years of taxes to make sure that you took all the benefits that you should have, tax benefits that you should have, and I know that I've seen them get people, by going back 3 years, I know that I've seen them get people refunds, so it's definitely well worth your time to have them look over your stuff. And the only other thing that I can say is make sure that you keep your receipts for convention, because that's all going to be tax deductible, which is awesome. I do have one question about that, Michael. So someone goes to the convention, and the convention gets over on Saturday. Saturday is part of the day, where you're quote unquote working because you have to be at events and stuff. They take Sunday off, all of Sunday off, and then and they fly back halfway through Monday. Is that still the whole thing?
Yeah.
Okay. Yay. Okay, so all of your what about meals and stuff when we're meals and expenses? Are those still only 50% deductible, or okay?
Yeah. Yeah. The only way that meals and is more than. There are a couple of examples. One example
that if you are a on-the-road truck driver, IRS gives you 80% instead of 50%. And if you are buying food at a grocery store, you will have a kind of like a business or something like that. That's another area that can be 100%. That's an area that can be 100%. 50. But yeah, you're entertaining at a restaurant. That's all.
All right. Before we let Michael go, do people have questions? Really quickly, I know that it's getting late. It's 9:45. I just wanted to make sure if anybody has any questions before we let Michael go, that we, get answers to quick questions. Otherwise, take his information down, 603-486-1809, and Michael at joecraftcpa.com, and get in touch with them. And I really encourage you to get your last 3 years of tax returns reviewed by these guys. Like I said, they've helped a lot of people, from real estate investors that I know to people who are home-based business owners, and they've really helped out a lot and gotten people some refunds. So yeah. I don't see any questions coming across, Michael. So I'm going to say thank you very much for providing us all with this information. And I'm going to stop the recording right now. And again, have a wonderful evening, everyone. Thanks for jumping on.